Welcome to both of you. All right, David, are you just gonna what are you following then? Football? What matters for investors?
Well, unfortunately, football doesn't matter for investors, but it certainly mattered last night for this Cowboy fan. But in terms of what the Fed will do, I think that the Fed is following markets. Markets are not following the Fed, and I think it is a fait accompli that they're going to pause again at the end of September. Futures are still indicating a sort of a jump ball around the November meeting. The odds are a little weighted towards, again, no new movement. But at this point, the CPI issues are very, very clear. Oil prices may very well bring headline levels higher, but the shelter housing number that has been so distorted, so lagged and so wrong for so long, that's coming down, and the Fed knows it.
Sure, and obviously rents are going to come down even more given the supply coming online. Brian, you say CPI just doesn't matter like it once did.
No, I think same lines, right? I mean, the Fed did a lot. We have to wait and see what they've accomplished. The numbers are going to move around a bit, but the exciting part is over. And so watching every single number, are they going to go, not go? They've told us, right? They want to pause. They want to watch it. And I think really deep down, they don't want to do any more. Time will tell. The market will force their hand potentially, but not for a while.
So are both of you saying that even a hotter than expected CPI number you don't think would force their hand? I would argue maybe if inflation expectations and the consumer sentiment print, like if those all of a sudden jump to 5%. But even then, Brian, what do you think?
Expectations have been pretty well anchored. Tips break-evens haven't done much. Sure, there could be reasons why the Fed would want to do more. But I haven't seen, I mean, listen, what I'm surprised they haven't done is to point us away from the month-to-month CPI data. If they were worried about something else, they should probably tell us now. But I don't think that even a hot number here is going to force their hand.
Is it jobs then? What becomes the number one, the tier one data point?
Yeah, I think what we need to look at is some more forward-looking data, right? Not the monthly jobs print, but, you know, claims has been well behaved.
Yeah.
I said rental information is coming out, and there's some reason to believe in some softness out there. But, yeah, I think moving away from every single month CPI number and every single month's employment number as the thing that's going to change the next meeting, it's time to do that.
What would you say, David, are the most important kind of data points now to follow?
Well, one of them I don't want to be cynical about, but I think it needs to be mentioned. It's the fact that we're going into an election year. And I just don't believe that the Fed wants to be raising rates going in the election year. And that's not, and Kelly, that's not a partisan comment.
Right.
It could be either party in office. It's just simply that it can be perceived as putting a thumb on the scale into the national politic. They didn't touch rates all of 2016 when their dot plot said they were going to raise rates 4 times. And so you go back to 94 and the heat that Greenspan took in those midterms when they were raising rates in the middle of that first Bill Clinton term. They've mostly stayed out of the politics since. And I think hiking rates when they're already at 550 basis points going into election year, it's just very unlikely.
So let me kind of translate this also to, you know, David obviously followed bonds more. I'm sorry, Brian, bond more. David, you're more of a stocks guy. And when I looked at your list and the fact that you're looking at Kenvue jumped out to me because Kenvue, okay, one of the newest, you know, most esoteric stocks, owner of Tylenol, you know, the spinoff obviously broke below its IPO price and has been getting a lot of attention ahead of the big IPO week that we're having. Why do you think this is an area for opportunity?
Well, again, we already owned it. It just didn't exist because we owned a Johnson & Johnson, and it was a third of the Johnson & Johnson balance sheet was this consumer products division. And so now we have a separated entity that has a lower multiple, a higher dividend yield, and like you mentioned, Tylenol, Band-Aid, shampoo, all of these wonderful consumer products that we believe in, and we believe it's at a multiple opportunity that will do well. It sold off last week because a lot of people got Kenvue at a 7% discount in the spinoff that J&J did, so they were taking advantage of that free money. Now we think it sort of reprices, resets, and we think Kenvue is a long-term hold. All
right, and of course, it fits more in with where you are in the market. A little worried still about some of the valuations, high tech, that kind of thing. Brian, let's talk bonds. I see the 10-year inching back up towards 430 today. To quote your colleagues from a different part of the company, is this the buy of a lifetime?
I don't think we're there yet, Kelly. I mean, election years are interesting, right? I mean, I don't want to play politics, but you have to think about it, right? Who's going to cut spending into an election year? Some parties may want to cut taxes. Some parties may want to spend more. I think both involve higher deficits. We already have a pretty high one to start. So for a 430 10-year looks high because we're so used to it being so low. But why not just take a 2-year a 2-year Treasury or in a money market fund.
And
or,
would you?
Yeah,
at
I would.
These rates? So
yeah.
you'd be comfortable owning and seeing the opportunity at the short end, but not so much in the longer end.
It's very tempting to say we're there, opportunity of a lifetime, things are going to slow. I think there's many reasons to believe. Look at the shape of the yield curve. Right? If the Fed eased 100 basis points next year and took us from 5.5 to 4.5, the 10 should go back to 100 steep. That puts 10s higher than here. So if the Fed continued to hike rates, wanted to slow things down, was being hawkish, I'd have a different view.